So with that, I'd like to introduce Alan Wang. Alan is our investment director, one of two investment directors from Value Partners. Now, those of you that have come to our roadshows before, you would have heard Alan speak. We're really excited, as I said before, because we have a really great news story. Really great news story. We've done really well in the last 15 months, and we look forward to the next 12 months. But I'll let Alan speak more about that. Ladies and gentlemen, Alan Wang.
Good afternoon, ladies and gentlemen. My name is Alan Wang. I'm the investment director at Value Partners, and I'm heavily involved in the managing of the Premium China Fund. Today, I will give you a very quick update regarding the Premium China Fund's performance, what has worked in terms of strategy over the past 15 months, and present you with 4 major themes of investment for the next 12 months. This chart shows the performance of value stocks versus growth stocks as represented by the MSCI China Growth and MSCI China Value Index for the past 2 years. And you can see from this performance chart, value has underperformed growth for the past 2 years, particularly since the second half of last year, where globally, money has been chasing tech stocks and growth stocks in general. Our fund actually performed quite strongly, but compared to some of the growth products out there, we have underperformed. Even though we delivered more than 20% return in 2013, but there are funds out there that has a particular focus on internet stocks, for example, return almost 100%. But we do believe that value still offers long-term performance advantage versus growth over the longer term. And you can see from this particular chart, the value index has really outperformed growth for the past 14 years. At Value Partners, being a value fund, we stick to our current strategy, and this is our discipline. This is the performance for the Premium China Fund, and it has offered very solid and steady performance versus a benchmark. Both, in terms of months to date, 1 month performance, 3 months performance, 6-month performance, and 1-year performance will have all outperformed the MSCI China Free Index. And will also have a lower volatility over the longer term compared to the index. This chart shows the current composition of the Premium China Fund in terms of sector exposure. We do focus more on bottom-up stock picking. As a result of that, our portfolio is quite diversified. And you can see from the right-hand table, this shows the top 10 holdings of the portfolio, and it actually represents a whole range of different sectors and industries. It includes automobile, real estate, semiconductor, technology, consumption, energy, pharmaceutical, utilities. So we buy stocks based on fundamentals, based on where the value is, rather than holding a very strong industry view. So for those of you who have listened to I speak last year in Melbourne, you might recall that I presented a few themes in terms of investment strategy to you. How have those played out? I will review them one by one today. One of the top themes that we presented last year was the B2H conversion. I remember 15 months ago standing here telling investors that I was very excited about the B-share reform opportunities. One of our top holdings in the B-share space was a company called China Vanke. It is not the only B-share holding, but it's one of our very top holdings. China Vanke underwent a painful 18-month process to obtain various government and regulatory approvals to convert its Shenzhen-listed Hong Kong dollar-denominated B shares into the Hong Kong Stock Exchange traded H shares. It actually needs approval from both the Chinese side as well as the Hong Kong side. The approval was finally given to China Vanke in June this year, and the company was successfully listed on the Hong Kong Stock Exchange on the 25th of June. The green line shows the performance of China Vanke share price as a B share, and the white line shows its performance as an H share. And the share price shot up by 40% since 25th June. And the reason for that is very straightforward. As a B-share company, like Jonathan presented earlier, the B-share market is a very small market. Simply put, a lot of global institutional investors, such as Fidelity, Templeton, HSBC Asset Management, etc., simply do not invest in the B-share market because the market is too small for them to worry about. Too much work, not enough exposure. But as an H-share company, that's the main playground for foreign investors when they come to Chinese equities investment. And Vanke, being one of the blue chip companies out there, with a total market capitalization of around $20 billion US, is definitely something that all investors must to pay attention to. So the liquidity research become much more abundant after Vanke become an H-share company. And this company alone has delivered very strong contribution to our performance in the month of July. There will be other B-share companies that will follow suit. The success of Vanke, which is one of 3 companies that has done B2H conversion so far, has triggered more interest by other B-share companies to think about B2H conversion. And we continue to like the B-share space. But that said, it is a very slow process. In the case of Vanke, it took them 18 months. Some of the sector views that we have over the past 15 months include healthcare. Healthcare is one of those industries that is more anti-cyclical compared to the economic cycle, particularly in China, where population is large and also is getting older. So spending on public healthcare, as well as household spending on healthcare products, will increase very solidly over the next few years. We do have a very decent exposure in the healthcare sector for the Premium China Fund. The sector has rallied a lot over the past 12 months, but we have been taking profit in some names and adding position in others. But that's more of a valuation call. Nevertheless, one of the top holdings, Huadian Pharmaceutical, you can see from the price chart, this share price has done very, very well over the past 12 months. Railway is one of the very few sectors that's related to fixed asset investments that we do like. There are a lot of infrastructure in China that is saturated. I wouldn't say overbuilt, but definitely saturated and mature. There's only so many airports, so many ports, so many toll roads that one can build. But high-speed railway is one area where China continues to expand further, including the density of the railway network is also getting more aggressive as well. And that means that on the railway lines, they need more locomotives, more passenger trains to run on them. And we believe that this is one of the very few sectors that will continue to attract very robust infrastructure spending. Some of you might have heard that Premier of China, Mr. Li Keqiang, has been promoting Chinese high-speed railway export every country he visits. And recently, Thailand has decided to construct 2 high-speed railways linking Thailand and southern China. And I'm pretty sure some Chinese companies will be involved in that project. And finally, automobiles. Automobiles is a sector that we like for the past 15 months. One needs to be very selective in the automobile industry. With the anti-corruption campaign of the Chinese new leadership over the past 12 months, high-end luxury spending on automobile has come down. So the sales rate of Ferraris, Rolls-Royce, Bentleys, Maseratis has slowed down. But the middle class is also growing. So you can see that the auto industry actually delivered 15.7% year-on-year increase in 2013 and 11.2% increase in the first half of this year. A lot of that is driven by more household well-known brands such as Ford, Volkswagen, Toyota, Honda, and the like. SUV is also a very popular type of car in China. And for the past few years, including the first half of this year, the pace of increase of SUV sales has outpaced that of the general passenger car market. We like Chang'an Auto. For those of you who were here last year, I talked about China Auto being the joint venture partner with Ford in China. And Ford, being a laggard in terms of overseas brands in China, has been actively promoting and aggressively launching new models into the Chinese market. So overall, the Ford brand has been growing at a much faster rate compared to some of the incumbents, such as Volkswagen and General Motors and Audi. So we continue to like this company because Ford is continually introducing new models into the Chinese market. And we believe that even though share price has run up a lot, there are definitely more upside for this particular stock. So those are some of the key themes I presented last year, and they have worked out reasonably well for us. We have delivered what we have set out to do 15 months ago. Now I'm going to talk about the key themes for the next 12 months. And this is actually quite important. And like Jonathan pointed out earlier, we are getting very excited in some of these opportunities. Here are the four main key investment themes. And the one I want to focus more on is Shanghai-Hong Kong Stock Connect and SOE Reform. With respect to the Shanghai-Hong Kong Stock Connect, we all know there are A shares and there are H shares. There are roughly about just under 100 companies that are dual listed in both markets, i.e. they have both A shares as well as H shares. The shares trade on different stock exchanges. The denomination of currency is different, but shareholders' right towards dividend, towards votes, is exactly the same. There's no difference in that. But because the two markets are a lot different in terms of investor behavior, and capital control is actually in place, therefore, the valuation and the prices of the two share classes are a lot different. Of the A shares that are currently trading at a discount versus the respective H shares, the average discount is about 16%. For foreign investors, particularly more sophisticated investors, naturally, you will buy the cheaper of the two and sell the more expensive one. How do you achieve that? You have to have QFII quota in the current environment in order to do that. But QFII quotas is very difficult to obtain nowadays. So what the Chinese government has launched as a pilot program for the next stage of opening up its equity market is what this thing called Shanghai-Hong Kong Stock Connect, which means that for investors who are based in Hong Kong with Hong Kong trading accounts, they can now trade the domestic A shares listed on the Shanghai Stock Exchange without actually opening up a local trading account. They can trade the A shares just like they trade other Hong Kong listed shares in Hong Kong. And they can trade a total of 568 companies that are listed on the Shanghai Stock Exchange. Mostly, these are mid to large cap companies. Vice versa, for investors who are from the mainland, they can now trade Hong Kong shares from the domestic trading accounts with domestic brokers. And they can buy and sell 266 companies that are listed in Hong Kong. They're also mid to large cap companies. This is the next step of China relaxing its capital control, particularly involving the equity market. The implication and benefits. This will allow investors previously who are not able to invest into the Asia market access the Asia market through the Shanghai Hong Kong Stock Connect program. Investors, backtrack a little bit. In April this year, MSCI, the index provider, has issued a consultation paper considering including the A-share market into its global emerging market index. The size of the A-share market, as it stands today, is $3 trillion. That makes it the third largest equity market in the world, but it's closed off to the majority of foreign investors because of capital control. MSCI has put that review on suspension for further review in April 2015. The reason for that decision is because the Asian market, due to capital control, is not a readily investable market. If they put 5% weighting into the emerging market index, ETFs have to benchmark against that. But if the ETFs cannot obtain QFII quotas, how can they invest into the A-shares? That's a practical difficulty faced by MSCI. So MSCI has postponed that decision for further review for 1 year, pending the outlook of the Shanghai-Hong Kong Stock Connect, eventually in our belief that the Asian market will be included into global indices. It will also help narrow the gap between the valuation of the A-shares and Hong Kong listed H-shares, i.e. there will be a convergence of valuation and price, which during the process will represent an arbitrage opportunity, i.e. A-shares that are cheaper will see rise in value, H-shares that are more expensive will be shorted by hedge funds and fall in value, and they will converge. Over the past 1 month or so, as Jonathan pointed out earlier, we have already seen $2.2 billion of inflow into Chinese equity, Asia ETFs that are listed on the Hong Kong Stock Exchange. For investors who cannot access the Asian market through QFII, that is the next best thing for them, the next best proxy for them to gain Asia exposure. We also know that some of the more expensive H-shares are already heavily shorted by hedge funds out there. Not because of fundamental, but simply because of convergence. And if you try to short them further, borrowing costs and availability of stock for short is very difficult to obtain. So for us, this is going to be a huge opportunity. The program will be launched in the middle of October this year, which means the window of opportunity is right in front of us. Even though the Asia has rallied by 7-8% in the month of July, because the price difference still exists, we believe there's at least another 10 to 15% upside before year's end. Now, one might ask, okay, that's fine. There's a short-term trading opportunity that you can arbitrage against. You make 15% by the end of this year. What happens after that? Mind you, the Shanghai Stock Exchange only represents half of the Asia market. There are 2 exchanges. The next one is the Shenzhen Stock Exchange, which represents the other half of the Asia market. And this is only a pilot program, so which means that if successful, the regulators will launch the Shenzhen Hong Kong Stock Connect in 2015. So there's a second wave of arbitrage opportunity. Beyond that, MSCI is most likely, in my personal opinion, to start off with a low weighting in the MSCI Emerging Index for A-shares, probably start off somewhere between 3 to 5%, and gradually increase that to 30%. Now just imagine, if the MSCI Emerging Market Index has 30% weighting of A-shares by 2020, how much passive money is going to flow into the market, the A-share space? For us, we want to be in front of that. We don't want to ride the trend. I mean, riding the trend is okay, but we want to be in front of that to capture as much alpha as possible. So the good news for the Premium China Fund is that through our own QFII, and QFII we have obtained so far from the market, we have 10% exposure of the Premium China Fund in A-shares already, which means that we can simply wait and for the arbitrage to occur and lift the value of that 10% exposure. We want to add further if we could, but that depends on whether we can obtain further QFII quota. So we're in a very good position to deliver both absolute performance as well as relative performance in the next 6 to 12 months, because our benchmark MSCI China Free Index do not have A-shares. Just some very quick example. Anhui Conch Cement It's a dual-listed A&H company. I use this as an example because it has the biggest discount. Its A share is now trading at almost 30% cheaper, actually more than 30% cheaper than its H share. Same rights, same to everything, just different price and valuation you pay. It's China's largest cement producer, so it is a blue chip company. Fundamentally, there's nothing wrong with it other than exposure to fixed asset investment. But, for investor, naturally you should buy the cheaper of the two as long as you could. Next example, in the Mongolia Yili Industrial. This is actually the world's 10th largest dairy producer and China's largest, versus the second largest in China, Mongolia, listed in the Hong Kong Stock Exchange. Yili is a pure A-share company, trading at 18 times PE. Mongolia and H-share traded at 28 times. They're direct comparables, very similar fundamentals. And actually, if you did the research, Yili is slightly better than Mongolia, and it's a lot cheaper too. So this is another type of company that foreign investors will want to invest into when they gain A-share exposure. The next thing I'll present is regarding telecommunication. Jonathan mentioned earlier regarding 4G LTE network in South Korea. In China, the three major telco operators, China Mobile, China Unicom, and China Telecom, all received their 4G licenses at the beginning of this year. And they're actively building up 4G LTE infrastructure. A lot of capital expenditure has gone into the sector already. A lot more will be going into it over the next few years. And the two companies that benefit most from 4G capital expenditure is Huawei, which unfortunately is unlisted, and ZTE, which is listed in both the Shenzhen Stock Exchange as well as Hong Kong. These two companies, not only that they have a dominant market share of 4G capital expenditure in China, in the case of ZTE, running between 26 to 40% market share with the telco operators, but they're also very strong exporters. If you go to a Telstra shop today, you buy one of those wireless router things that can connect 5 devices, it's either made by Huawei or ZTE. And you go to Europe, you go to the States, it's the same case. With 4G network, naturally there will be smartphone handsets that are 4G. China sold 9.3 million units of 4G handsets in the first half of this year. 8 out of the 10 major brands of 4G handsets in China today is domestic brand. The only other two is Samsung and Apple. Samsung has its own issues. It's actually losing market share globally. And Apple, mostly due to lack of new product. But we know that Apple might have some rebound with the launch of iPhone 6. But that said, the Chinese is getting more competitive in the consumer electronic goods space. I said it many times before, China is no longer competitive on the low end of the value chain in terms of manufacturing. It's losing market shares in textile, garment, furniture, toys, etc., to the Southeast Asian economies. But at the same time, it's gaining market share in consumer electronics from countries such as Japan, Korea, and Taiwan. China's manufacturing is moving up the value chain gradually. One other company I'd like to point out in this slide is a company called Sunny Optical Technology. Personally, I like this company a lot, and it is one of the positions within our premium China fund. Sunny Optical is one of the world's largest manufacturer of mobile handset camera and lenses. Recently, Amazon launched its Amazon phone. It has 6 cameras for 3D imaging. All 6 camera modules is made by Sunny Optical. Last Friday, an Israeli company called Mobileye listed on Nasdaq. First day of trading, share price up 50%. That particular company makes front collision systems that are used on cars. And the module, again, is supplied by Sunny Optical. And finally, on your cars, some of the cars today have have reverse cameras. 25% of the world's reverse camera used on cars is actually made by Sunny Optical. 25% global market share. And by the year 2018, in the United States, all new manufactured vehicle has to have a reverse camera installed. So the market potential is huge. I'm from Beijing. Beijing's polluted. Simple as that. China has 80% of electricity generated from coal-fired power stations. Because the energy demand is so high, they can't reduce the number of coal-fired power stations, but they can increase the alternative and renewable energy from other sources, i.e. make the percentage, the mix, different. So in the next 5 to 10 years, or even beyond that, China will be more focused on installing more solar as well as wind power capacities. To some extent, nuclear will be another important source of energy. We invested in a company called Huadian Fuxin. This company has a mix of hydro, wind, thermal, as well as some equitable interest in a nuclear power plant in China. And share price has done tremendously well for us for the past 12 months since we invested. And we expect CAGR for this company's net profit growth between 2013 to 2016 to be 20%. Very solid utility company. Finally, the last theme to talk about, SOE reform. Chinese SOEs are inefficient. They're too big, too bureaucratic, and the government knows that they need to do something about it. So just like Australia, who has undergone a wave of privatization over the past 2 to 3 decades, China is also privatizing at least part of its SOE sector. They're bringing in outside investors, strategic as well as private investors. They're bringing in third-party board members as well as management in order to turn these SOEs more efficient, as well at the same time unlock some of the hidden values that are controlled and owned by the SOEs. PetroChina has decided to sell part of its interest in the west to east natural gas pipeline. The sale was completed last year to some domestic insurance companies in China, and we expect further asset sale. But more importantly, I'd like to use this example, Sinopec, which is another oil major out of China. Sinopec is actually China's largest oil refining company. It has a marketing division which owns more than 23,000 service stations. Now, many of you here have probably been to China, and you have noticed that service stations in China is very simple operation. You drive in there, they usually have 6 to 10 pumps, you fill up your tank, and then you leave. There's no shopping there. They don't sell bread, they don't sell books, they don't sell newspapers, they don't sell drinks, they don't sell anything. Very simple stuff. For what Sinopec is doing now is they're in the process of a global tender to sell 30% of its marketing division to international strategic investors. We know for a fact that investors who are interested include oil majors, include retail companies, include logistic companies, and include PE funds. 23,000 service stations, that's 23,000 potential distribution points for goods and services. So you can imagine the value in that. Even in Australia, when I lived in Australia in the 1980s and 1990s, service stations were quite simple stuff as well. But today, all the major service stations are either linked to Coles or Woolworths. They are offering the convenience to local shopping to residents. Chinese service stations can do the same. My personal hope is that Sinopec will tie up with 7-Eleven, and they'll make it a very attractive asset. So as you can see, by selling down some of these assets to strategic investors, potentially it will unlock a lot of hidden value in the assets that the SOEs own. And Sinopec is just the beginning, and we're hoping that more SOEs will follow suit in the near future. We always talk about the issues regarding investing in China. I mean, I'll give you the good points, but I don't shy away from the bad points. That said, the bad points are always the same issues over and over. 5 years ago, people asked me, what do you think about property bubble in China? Today, you probably have the same question on your mind. I'm pretty sure 5 years down the track, you still ask me the same question. Generally speaking, China has put in a lot of what they call home purchasing restriction policy over the past couple of years to trying to curb the fast rise in property prices due to investment and to some extent speculative activities. That has worked. We have already seen 3 consecutive months of property prices decline nationally. Over the past 2 months or so, local governments are now relaxing the home purchase restriction policies. And transaction volume is now gradually rebounding. The market is now undergoing a process of digesting existing inventory. The market is big. There are over 100 cities in China with a population of at least 1 million per city. And you can't just simply generalize the state of the property market across all these 100 cities. For those who have been to places like Beijing and Shanghai, you see that prices are more expensive in relative sense, but also demand is very strong because there are a lot of people that flock into large cities, just like any other country, and want to own a piece of asset or house or unit, whatever, in the tier 1 cities. But on the other extreme, there are certain degree of oversupply in the tier 3 cities, and in extreme cases, result in ghost towns. And there are times that, due to previous mining booms, a lot of liquidity flood into the local of those tier 3 cities, which has ultimately resulted in oversupply of property in those areas. For us, we are cautious, but we're turning slightly more positive on the Chinese property market. But when it comes to investing, we need to be very selective. We only invest in companies that has national diversification and that has very strong management track record and brand name, such as China Vanke. Local government debt. The Chinese government or the Chinese National Audit Office did an audit of all the central and local government debt last year. The debt to GDP ratio as it stands at the end of last year is 54%. Not a small number in absolute sense. But in a relative sense, if you compare China's debt to GDP ratio versus some of the OECD countries, you will see it's still far below the red line. And people always talk about the liability of local governments. What about the assets? Local governments are the biggest shareholder of the local SOEs. Through the SOE reforms, or even selling down, privatize some of these SOEs, will fix the balance sheet quite significantly, or unlock the value of the asset side. So not saying that local government debt is not lethal, or they're not a long-term issue, but there are many ways of actually repairing it over the course of years. The local government do not have an interest repayment issue. The average interest repayment, the interest coverage of local government debt is 3 times. So they can service the debt quite promptly. The potential problem comes to repayment of principal. So they can either sell down the asset, debt for equity swap, securitization, privatization, are all ways of resolving the repayment of principal over the longer term. So we don't believe that these are issues that will result to a hard landing of the Chinese economy, even though they are issues that need to be addressed. Very briefly on corporate governance, again, something I get asked over and over. Corporate governance is not an issue that's related to China. It really is just everywhere. And for us, who has been doing Chinese equity investing for the past 21 years, we have built up a database of the companies that has a good track record versus the companies that are suspicious. We're only invest in companies that are genuine and has very good management and track record over the longer term. And we are generally very cautious of companies that are recently listed, particularly with very auspicious sort of a business model. Our team of investment professionals, with now over 50, does a lot of grassroots research and cross-checking. So in conclusion, just very briefly regarding the fund flow, since July this year, there has been over $2 billion of US dollar that has flown into China Asia ETF listed in Hong Kong. China is the most underweighted market in the emerging market right now. It has underwent 4 years of bear market. But we're seeing global investors, asset allocators, taking profit gradually from the US market and shifting it back towards the emerging market, particularly China. I get conference calls requests, investor meeting requests from our investors around the world, from North America, from Europe, asking me about this Shanghai-Hong Kong Stock Connect program. So we think that in the short term, the catalyst will be the very important factor that turns the market around after 4 bad years. The valuation of the China equity space is one of the cheapest in the region. And yet, at the same time, we are still delivering high single-digit earnings growth. So I see that the risk-return profile for China equity space is very attractive. And finally, I'll leave you with this. For those who does prefer to read the press rather than listen to fund managers sometimes, this is what the press is saying. This is sourced from the Financial Times, dated 24th July 2014. China's equities has always delivered, even though volatile, but for the past 4 years, has delivered on average 30% return in the second half of the year. So if you ask me for short-term catalysts, this is it. But over the longer term, let me tell you, with the Shanghai-Hong Kong Stock Connect, with the current valuation, with the government refocusing on economic growth and development after the recent anti-corruption campaigns, we are going to see a much better 2015 and beyond as well. Thank you very much.
Thank you, Al. The last thing I want to speak about before we go to Q&A, just for 5 minutes, is this product. This product turns 3 at the end of this month. And everyone that I know about, let me put it up a bit, yeah. Everyone that I know about is struggling to find yield. Struggling to find yield for your clients. No matter what one of the largest bond managers wants to think and say, I just don't understand how bond rates going up or interest rates going up is not going to impact the way that they're managing money. We launched an Asian income fund focusing on bonds that are not rated and are high yield. There is a lot in our portfolio that's unrated. But ladies and gentlemen, let me ask you, does an unrated bond mean that it's a bad bond? Does an unrated fund make it a bad fund? This fund has generated 12% in the last 12 months ending June. It is right across emerging markets, including Middle East and Sri Lanka and Japan. Think about the yield strategies you currently use for your client. The 2 arrows is where I want you to focus on. Annualized return 12.6% for 2 years and 11 months. Annualized volatility is 5.5%. Find me a fund in your portfolios at the moment that has a Sharpe ratio of 2 or above. 2 or above. Think about the cash yield. At the moment, it is going to pay 8.4% per annum with a yield to maturity at 10.7, with the average maturity at 5.3 years. So, what that means is that if we hold the portfolio as it is today, assuming no defaults, and we've never had a default in any bond that we've bought, you and your clients will get 10.7% per annum for the next 5.3 years. That's all we are doing, with a duration of 3.1. Our family seeded the fund, and we don't like term deposits because we're getting paid every quarter at least 1.5%. At least 1.5%, in which out of the 40% total return that clients have gotten, 30.5% of that return was paid out, an income. The fund sits at $16 million. It's been seeded. It's a full portfolio at 57, and that's the other thing we don't believe in. We don't believe in bond funds that are holding 500 positions. It just does not make sense because you can't monitor 500 positions. And so this is what we're doing. If you still don't believe us, have a look at us against the market. Where we sit in the market, we have a lower risk profile than the highest risk bond fund, in my opinion, in Australia would be something like a Franklin Templeton multi-sector bond fund. We are buying ordinary bonds in the marketplace, generating a cash yield of 8.4%. And with this type of track record, once we turn 3, everyone can see where the value is.